Let's go to Malkiel's 8th rule. Bow to the wisdom of the market. No one wants to admit that an amorphous, inorganic entity such as the stock market is smarter than they are. Certainly not the financial professionals who earn lucrative fees and commissions for telling naive customers that they know best. Also not the do-it-yourself day traders who just absolutely happen to know what they can pick and choose where few, if any, have profited before. And yet, the cold, unflattering, and yes, unexciting truth is that the financial market, that sprawling, clumsy behemoth, is smarter than any individual. Ultimately, it is smarter for one reason, that it is not you and I who decide the market price. It is the stock market that decides the market price. And the stock market decides the market price based on the collective feed of buying and selling orders that come into it on a daily basis. Based on the volumes of transactions that actually occur, that are actually matched, you have a price. And we cannot control that. We may have our ideas, we may have our studies on a day-to-day basis. You cannot control that, I cannot control that. So this is what we have to understand. And this is what a lot of people fail to understand. Actually, on this one point, I slightly disagree, not with Malkiel's concept, but with his wording. He says, bow to the wisdom of the market. I would have worded it a little differently. Bow to the foolishness of the market. Very often the market appears to be totally foolish. Some event we read in the newspaper in the morning, at let's say 8 o'clock when we are having breakfast, the market is going to fall today. Then the market opens. The damn thing has gone up. So what we thought is going to happen, what has happened in the market are two totally different things. Our analysis may not be wrong, let me tell you. There are many times when the market has actually exhibited foolish behavior. But why do we have to bow to that foolishness? Because, once again, it is the market that decides the prices. It is not we who decide the prices. So that is very, very important to understand. Smarter, that is, that no one can consistently outfox the market by predicting its movements. He's got the correct idea. Nobody can outguess, nobody can outfox, we can't predict. The road to your financial success is paved with this understanding. I am an equity investor. I should not get into equity investing unless I have this planted firmly in my mind. That when I am an equity investor, I have certain options. The market has certain powers. I cannot alter the market. I do not have the resources to alter the market. I have to take the market as it comes. I have to accept that there are risks in the market. I have to accept that the market may move in a manner that I do not agree with, that I did not foresee, that I could not predict. And I have to also accept that despite all these happenings, if I remain true to my mission as an investor, I will come out successful over time. I will come out successful using simple, steady investing techniques. The one point that has been repeatedly proved is that in the long run, the market knows best, regardless of what aberrations there may be in the short run. That is why you have these long-term investors who have made a lot of money. I have come across several people who have steadily invested in the markets. Let it be through equity mutual funds, let it be through direct equity. But we are talking about they have invested for 30 years. And they have invested in a diversified portfolio of stocks. By no stretch of imagination are their portfolios the best in the business. No, they are diversified portfolios of stocks. Now, when you speak to these people, very often they are in their late 50s, 60s. When you review the portfolio with them, I get one consistent feedback. The feedback goes something like this. Thank God I started investing in equity at a young age and I continued. I never expected my portfolio to be worth so much when I started out. I never expected that I would build up so much of wealth when I started out many years back. What are they trying to tell us? What do they mean that they never expected? When they started out in equity investing, they knew that they are going into an avenue of investment that is risky, where prices fluctuate. So you can have theoretically something called a maximum return and a minimum return, or even sub-minimum. You can have losses, not just a minimum. This is a negative return, let's call it. Very often we are used to these three terms: losses, minimal returns, maximum returns. Now traders in the stock market try for maximum returns. They attempt this. What they actually realize is one of these two. Now investors do not want this, they do not want this, they also do not want this, because there is one word that occupies the space between this, and that is called optimum returns. We want, in a given country, in a given market, what are the average returns that we should get on equity? We want those returns, and those are called optimum returns. And I always tell investors, please get this one word by heart and don't forget it. Okay, this should be your goal. I do not want maximum, I do not want minimum, I want optimum. If the stock market has given us in India 15% over the last almost 4 decades that we have had the Sensex being calculated, and if somebody had invested on those 4 decades and has got around 15%, 0.5%, 1%, this side, that side, let's not worry about, because there are also the dividends that have come in. You got the optimum returns. And that has been enough to make you seriously wealthy, as we have seen. But these people are telling us, when we started out investing, we knew the market will give us optimum. What is the meaning of optimum returns when you translate it to reality? It only means higher than inflation. This is what I have to earn in order to become wealthy. If the inflation rate in a country is consistently 10% over 3 decades, and I have earned 13%, my wealth has grown. If I had invested in 3 decades in gold, gold would be likely to give me an return equal to inflation, not higher than inflation, which means, okay, the value of my money has been protected. But one of the fundamental objectives of equity investing is to grow your wealth, which means you have to earn higher than inflation. And this is a very, very important concept to internalize, because while inflation can remain relatively stable in a market-oriented economy over the long period, you also can have changes. And we are living in a time when one such change is slowly becoming visible in India. You see, ever since independence and once income tax was introduced, and once the government started deficit financing, we ran up fiscal deficits after a few early budgets. For something like 60 odd years, we have consistently had an inflation rate of between 9% and 9.5% at the consumer price index level. And against that inflation rate of 9.5%, the stock market has given us 15%, and people have become very, very wealthy because of this. Just a 1 or 2% increase over inflation over a period of 30, 40 years is enough to really make you wealthy. And here we have had something like 5% easily. Is this going to happen in the future? I'm afraid not. Because over the last 5 or 6 years, there has been a seriousness in the last 1 or 2 governments in power to curb inflation, to control inflation. And the current thinking of the government is very clear. We are going to strive for an inflation rate in this country of 4%, plus or minus a variation or minus 2%, which means this is our target. If it drops to 2%, okay, we do nothing. If it rises to 6%, we keep a watch, but that is also within our tolerance limit. If it rises above 6%, we are going to take some serious fiscal and monetary measures to get the inflation down. This is what our target is. Now, let me tell you, it's not going to be easy to achieve this. This is more achievable. That is, the upper range of the inflation rate is probably more achievable. But we were talking about a 9% inflation rate formally, and the stock market was giving us 50% higher than this at least. Do you think you're going to get your 15% returns in the next 3 decades if the inflation rate is going to be 6%? I'm afraid not. If the inflation rate is going to be consistently 6%, your bank deposits, government bonds, all the other things are also going to come to around this level, maybe 0.5%, 1/4% more. Bank deposits are virtually there now. So what should you expect from the stock market? So long as India remains a developing country, this is something hard to digest, I know. But so long as India remains a developing country, if there's going to be something like a 50% premium, you should be very, very happy with 9% returns from the stock market in an era where inflation will be controlled at a maximum of this. Believe me, if you only get this, with this situation in existence, in 3 decades you will be seriously wealthy. So when we talk about the optimum return, it has to be viewed in line with inflation. Long-term trends in inflation. Not every week what is announced, every month what is announced. And before we break, let me come back to one point. A genuine stock market investor. We have these 4 situations, but the aim is here. The aim is here. When they come back and tell us, okay, we have invested for 35 years, this is now the size of our portfolio. When we set out, we didn't expect to build so much wealth. What are they trying to tell me? That their investment experience in the stock market was better than they expected. Okay, so coming back here, this is what they expected. So if it is better than they expected, it should be little higher than this. There is one beautiful sweet spot that an investor gets. It is not the maximum return, because nothing is maximum. Even if I'm Warren Buffett, I'll still want to increase my wealth. But there is a sweet spot here, which is a little higher than optimum, better than expected. And if you are a genuine stock market investor, aiming for this, very often what you realize is here. You not only get the optimum, you get a little higher than the optimum. To quickly refocus on where we are handling Malkiel's 8th rule, bow to the wisdom of the market. The beauty of bowing to this wisdom of the market is that the market will always give an investor the optimum return. The market may also give the investor a slightly better experience than the investor expected over the long term. That's the bottom line, over the long term. In the short term, you will not be driving along a beautiful highway You may be driving around very bumpy roads. You can have a lot of fluctuations. You can have volatility. You can have discomfort. You can have outrageously high booms, bubbles. You can also have serious recessions, gut-wrenching, frightening recessions. The market gives you all this. What depends is how we take what the market gives. If we understand that all these things are part of the market and we are willing to accept, then we are investors. We have the right to call ourselves investors. We're the badge investor. So we have to accept that the market is the final determinant of stock prices. We have to accept that in the long run, we will get the optimum prices. We have to accept that when we invest steadily over long periods of time, taking advantages of both the recessions as well as the booms, our returns may be slightly higher than optimum. This has at least been the experience of almost all genuine long-term investors. And this is what makes equity such a rewarding and fascinating avenue of investment. It's time to face reality. There is no evidence that research, even the research of the institutional investor, adds value. Academic studies only confirm what we all believe. The stock market is highly efficient and stock prices incorporate virtually all information. There was a time in the United States where fundamental analysis, a value-oriented approach, of which people like Benjamin Graham, Warren Buffett have benefited, they were able to produce above average returns. This kind of situation that we have seen in India over the last couple of decades. But the sad fact is that today, in any period of 10 years in the United States, 80% of the actively managed equity mutual funds underperform the S&P 500 index. And let's understand that these 80% of actively managed funds, or the 100% of actively managed funds that underperform the index, are not managed by some MBA from Bihar. These are all managed by highly competent professionals who have graduated from Princeton, Yale, Harvard, the Ivy League. And they are not able to beat the market 80% of the time. That's why Malkiel says, bow to the wisdom of the market. The market is the ultimate. Okay? The market gives, we have to formulate our investment plan to get the best out of the market. Never think you know more than the market. Nobody does. This has been proved again and again and again. The first great book that I had the good fortune of reading was A Random Walk Down Wall Street by Burton Malkiel, the thick book. We are seeing the thin book in this series of lectures. And that very first statement, that you can train a chimpanzee to throw darts at a dartboard, on which you put the stock prices page of the Wall Street Journal, and wherever that dart falls, pick that stock and construct a portfolio of stocks. This portfolio of stocks will do as well or as badly as any portfolio picked by the experts. In short, a totally randomly selected portfolio has an even chance of performing as well as any portfolio picked with a lot of study. So the only issue that remains is that you must pick the quality stocks, preferably the better stocks. Restrict yourself to perhaps the BSE NSE 100. If you want to go beyond that, maybe to the BSE NSE 200, but even that may really not be necessary. And having picked the best stocks, ensure that you continue on the path of diversification, because you do not know how the market is going to behave, much less do we know how individual stocks are going to behave. So the only point that is left to us is diversification in stock market investment and asset allocation in our overall financial scheme of things. Ultimately, it comes down to only these two things: diversification and asset allocation.